We've sold off so hard that selling begets selling, especially because if you think about the fact that so much of the stock market now is basically indexed ETFs. And they are just basically what's called flow traders. They go one way or the other way. So once the sell-off starts to really accelerate, there's just more and more selling coming afterwards. And I think that's what you saw. You saw a lot of forced liquidation over the last couple of days. The big question now is whether most of that forced liquidation is kind of done, and whether we can find some sort of a tradable bottom at this point. We are certainly very, very stretched on technicals. All the bulls are making a case right now that the technicals are so overstretched, we're due for some bounce regardless of just how bad sentiment is at this point. But it really remains to be seen.
Are you blaming market structure, Boris? Because we've talked about this for the last 2 years. I did a panel on it back in January in Phoenix where I talked about market structure and the risks of passive and ETF and was basically not laughed out of the room, but poo-pooed. Does the market structure have a huge role in what we have seen? There's a big article in the Wall Street Journal about just this last night.
Yeah. I think, people much smarter than I have made this point, and I tend to agree with them, that the problem with market structure is that investors have just been very, very much lulled into a continuous, what I think we call buy the dip mentality, right? Every time we've come down, they've been buying the dip, and this market continues to rally, and we have this sort of very positive market structure. People have, Ma and Pa, Main Street have been told, just buy ETFs and you'll be able to outperform. And now they're going to wake up, and I think this is the critical thing. The retail trader is going to wake up to Q1, to the end of the year, and look at this massive destruction on their 401k plans, and what's going to happen then. If they decide to sell, I think selling is going to continue irrespective of whatever happens in the market.
The question is this, Boris, outperform what? Underperform what? If you're buying the S&P 500, you're buying the market. These are low cost. I'm not bashing ETFs, but simply put, if everything moves, to your point, at the same rate, the flow traders, as you call them, then what exactly are you trying to outperform? The only way to do that would be to take specific individual bets.
Yeah, or, to quote great Mike Tyson, everybody has a plan until they get punched in the face. My point is that I think when the argument here has been that if you just simply buy the dip, over the long run, you're going to outperform. But when they wake up and they see 10%, 15%, 20% down in their plans, they may just decide to sell at that point. And here's the thing. Now, for the first time in 10 years, there's actually interest rates in the money market funds. I mean, we have, 2% yields. So the short term produces some sort of a return to the investor. They just may decide to park their money in cash for the time being. Cash has actually outperformed everything over the past quarter, which hasn't happened in quite a long time.
Let me ask a dirty little question at 5:06 a.m. on the day after Christmas. Why not here, Boris? Okay, and here's the thing. We ask a lot about why we're selling. I get that, because the market has been wiped out. How about this? Should the market have ever been as high as it was a couple of months ago? We hate the flow traders on the way down, but nobody says a word on the way up when everybody's buying everything with a push of a button.
No, of course, because huge amount of this buying has been just because of easy credit and bubble-like conditions. And when the party stops and everybody starts looking, it's what is it Warren Buffett said, that when the tide goes out, you find out who's been swimming naked. A lot of the fundamentals have just, I think, not held up. And I think the more interesting point here, and this is really going to be interesting, wealth effect. If this market destruction is really going to have a big psychological impact on the consumer in the first quarter of next year, that could again feed very negatively into further sell-off in the equities as we go forward. I'm going to be watching retail sales very carefully for the next couple of months to monitor just how confident the consumer is, given all this destruction we've seen.
Well, we have some positive data. I mean, the MasterCard data, we're going to hit on more than just a couple of minutes. It showed a 5.1% jump in retail sales over the holiday, the strongest in years. Is that going to provide a floor to the market? I mean, there's no sign the economy has slowed down. Maybe a little bit, but not 30% in 30 days.
Precisely. But that's the key thing. All of that is lagging indicators. Remember, that's all people feeling good because jobs were plentiful, growth was plentiful, and more importantly, their portfolio was really, really doing well. Now, are they going to reassess? Are they going to retrench in Q1? It's the forward data that I'm going to be watching for, because this is all backward data, which certainly is good, but it's really going to be January, February, March data that we're going to be watching.
But it's got to change the Fed's calculus, does it not, Boris?
Definitely.
It has to.
No doubt. I am convinced that, first of all, I think I'm not in a minority to think that the Fed is probably going to hold off in March, but it looks like I really think the Fed is on hold now for quite some time. Now, if the Fed decides to make another policy mistake and tighten, if they just simply decide to shrug off, if they just decide the market doesn't matter, that could really create actually recessionary conditions into the economy.